So they say risk happens slowly, then all at once, right? Look, today stocks are falling once again, and now the news headlines are mentioning financial crises. Is it 2008 all over again? For the last year, we've been talking about inflation and interest rates, and inflation is finally coming down from its peak, and interest rate hikes, well, they went from increases of 75 basis points to 25 basis points at the last Fed meeting. So that's caused stocks to rebound from their lows from last year. But then lately, in the US at least, we had SVB Bank and Signature Bank, and they failed for different reasons. And now they're under FDIC supervision, and bridge banks have been created to support the clients' day-to-day needs. And now the Fed's in an awkward position. Do they raise the rates at the next meeting or not? And just a few moments ago in Europe, the ECB raised the rates 50 basis points, which is very perplexing considering what's happening in Europe. I mean, just yesterday, Credit Suisse was in crisis mode, only to be rescued overnight by the Swiss National Bank thanks to a $54 billion credit facility secured against highly valuable assets. Now, while the bank for now is likely in a secure position, investors they don't want to be reading these headlines. I mean, they're in this mess, at least, because the bank allowed drug dealers to launder money. They're involved in corruption, a spying scandal involving a former employee and an executive, and a massive leak of client data to the media. And none of this is good for Credit Suisse or the banking industry, as it causes people to withdraw their money. And when that happens, at least in masses, banks can fail. And all of that has translated into the S&P 500 financial sector declining 10.26% over the last 5 trading days. So if you have money on the sidelines, is now the time to invest in banks? I don't know. But the series of events that are unfolding are certainly giving the majority of investors a reason to run to safety. However, investors should always remember the old adage, history is bound to repeat itself. And if we look at one of the most devastating events in financial history, the 2008 financial crisis, we can see how investors behave during those times and which sectors thrived during the same period. And one of the most important qualities of a successful investor is to be able to spot opportunities, regardless of which market we're in, a bull market, a bear market, whichever. So let's take a look at some industries that were resilient during the last financial crisis. All right, so healthcare tends to be less sensitive to economic downturns, as people will require medical attention regardless of the state of the economy. Even though during the financial crisis, all sectors were generally affected due to the impact on jobs and household income, healthcare still needs to operate with the people having an ongoing need for medical care. Yesterday, the S&P 500 Healthcare Index was down just 0.16% over the last 5 trading days, even with the massive decline in financials. By the way, a big shout out to barchart.com for letting me use their charts. I went ahead and I left a link in the description below for some quick access to all of their charts in the sectors that we talk about today. And by the way, it's all free. All right, so next we have the consumer staples, which include food, household products, and personal care items. And this tends to also be less prone to economic downturns. This is because people still need to purchase these items regardless of their financial situation. You're still going to be buying the toothpaste and bleach and Coca-Cola. Consumers always buy their basic needs in times of financial hardship. Even during the pandemic, consumer staples were one of the sectors that fared the best during the start of the COVID-19 crisis. And even over the same 5 previous periods this week, the sector is actually up modestly at 0.54%. Next up, we have the technology sector. Tech got pummeled last year thanks to rising interest rates, making it more expensive for companies to borrow money. But one of the things to note is that the tech sector was one that quickly recovered from the financial crisis, as companies in this sector tend to have stronger balance sheets and lower debt during these times. The tech sector has learned a lot from the dot-com crash in the early 2000s, which made them operate their business much more efficiently. And we see this today, even with modest layoffs in the industry that are being prudent, right? And here's the thing. Tech companies affect customers' way of life and businesses. And this continuous integration of technology into consumers' daily lives was the reason for the fast recovery in the last financial crisis. The main question now is if this short-term trend from the start of the year is going to continue. Over the last 5 periods, the tech sector is also down modestly, 0.37%, a far cry from the 10+% loss that we're seeing in the banking sector. The 2008 financial crisis taught investors valuable lessons about the risks and opportunities during economic uncertainty. And being defensive and focusing on sectors that have historically been through similar situations can give investors a blueprint of what to expect and how to navigate the looming crisis. Sectors like healthcare, consumer staples, and technology offer various degrees of safety and opportunities, but each have their own risks. Investors should always focus on quality companies that have a proven track record in the industry and have a strong history of stability and growth, as doing so reduces your risk. Capital preservation is always the main priority of any investor. Well, folks, that's what I got for you today. Thank you so much for watching. As usual, if you have any questions or comments, leave me a note in the comments below, because I'd love to answer all of your questions. See you in the next video.